All right, guys. So what I want to do here is I kind of want to go over the balance sheet example with you. Um, this is in your notes. It's page 13 of your notes. And we're just going to kind of walk through this balance sheet, and we're going to use the numbers that we used, that we derived earlier during some of the examples. So you can see here, we're looking at a balance sheet. What you've got is blank as far as the amounts go. Now the accounts have been left on the left side here for you. Typically that's not going to be the case. Typically you're going to have to come up with those accounts, know which accounts go on the balance sheet. But like we've talked about before, that's fairly simple to remember because the balance sheet, if you recall, is just a visual representation of our fundamental accounting equation. So we know our fundamental accounting equation is assets equal liabilities plus equity, right? So knowing that, we know what goes on the balance sheet. And what goes on the balance sheet is going to be anything that's an asset, a liability, or part of equity, okay? And we know what those parts of equity are, but we're not going to get crazy deep into those in this chapter. We're simply going to go through this example right here. So what we want to start with, the thing you should always start with, is going to be your title. Okay, so the title of the document, the title of the report that you're working on. In this case, we're working on a balance sheet. We're working on a balance sheet for the GAV Paint Corporation. So we want to have that at the top. GAV Paint Corp. Then we need to decide what is the statement. Well, we know the statement's a balance sheet because I've told you guys that several times now. So at this point, we should know that this is a balance sheet. And the next thing you're going to need to do is write down, is this an as of a certain time, a certain date, or is this for a period of? Like, does this run for the entire year? And we know, if we've reviewed our notes and we've been paying attention and reading the text, we know that balance sheets in particular are the only financial statement we have that are an as of date. So this is going to be as of December 31st, 2024. Okay, so this is your title. While it may seem like a small thing, it is actually incredibly important that we get this correct. All right. So make sure that this is as of. That's really the most important part. You want to know what you're looking at, who it's for. But for the balance sheet, we really want to make sure that this says as of. Okay. So again, now we need to decide what goes on this balance sheet. Well, we talked about that. It's our fundamental accounting equation, right? Anything that's an asset, anything that's a liability, anything that's an equity or a portion of equity is going to be included on the balance sheet. Okay, so let's get started. Like I said, we've already got all of the accounts listed out for you. What we need to do now is go back and find those amounts within the notes that we've already taken. So the first thing, and remember, we list these in order of liquidity. And what does liquidity mean? Well, liquidity simply means how quickly could it become cash. So what do we think the first asset should always be on our balance sheet? Cash, right? Because cash is the most liquid asset because cash is already cash, right? It takes 0 time to turn cash into cash. And we see that's in the amount of $80,000 if we go back and look at our numbers from previous work that we've done. Next, we've got short-term investments. You'll find out as we progress in this class that these are going to be something like cash equivalents, usually something like a U.S. Treasury bond or something that we can turn around and sell or turn into cash, convert into cash within 3 months' time. That's typically going to be our rule. Things that are equivalent to cash or considered cash equivalents are things that we can turn into cash within 3 months. These short-term investments that we're holding for sale, we're not holding them for investment or anything like that. These are going to be very liquid cash equivalents, and we can see we've got these for $60,000. And then we'll just keep going. We've got AR, or accounts receivable. It tells us this is net. This means that they've taken out any receivables that they think aren't going to get paid back. So one thing we'll learn in Chapter 4, Chapter 5, is that not all of our money that we lend out, right? We sell things on account. Not all of that's going to be paid back to us. So we remove those estimated amounts. What we think we won't get paid back, we remove that from our total AR, and that makes our AR become net AR, and that is going to be $180,000. Then we've got inventory. Why is inventory considered highly liquid? Why is it considered to be a highly liquid asset? The simple answer is because inventory is something that we expect to turn around and sell within the next year. We buy inventory for the purpose of selling it, typically, especially if we're a merchandiser or a retailer. We're buying that with the intent to turn around and sell it as quickly as we can, to turn that good into cash. So we see that we have inventory of $300,000 right here. Okay. And then we've got prepaid expenses. So why are prepaid expenses considered a highly liquid asset? Again, simple answer, we're going to use it up in the next year, especially something like prepaid rent. We've probably paid for a year's worth of lease. We're going to use up that resource in the interest of generating revenue over the next year. So that's going to be $30,000, which gives us a total current asset. Remember, these are all current assets of $650,000. We're simply just adding all of these together, and these are going to be our total current assets. Okay? So, next we're going to move on to our long-term assets, or our long-lived assets. These are going to be things like property, plant, and equipment that we've talked about somewhat. We can see that we've got PP&E of $820,000 right here. So that PP&E is a long-term asset because these are things that we're going to use over the course of several years, probably, to benefit the company, to benefit the organization, right? The reason it says net, you'll notice again that this says net, is because we're taking out depreciation. We don't expense these all at once. We don't take the whole expense at one time. We allocate that expense over several years or several months, however long we decide this piece of equipment is going to be valuable to us. Now we've got intangible assets. We won't talk too much about those. Intangible assets are things like goodwills, patents, copyrights, things that you can't physically hold that are actually useful to your company and may help you generate revenue. So we'll see those are worth $50,000 in our books. And then we have inventory or investments in equity securities. Typically, these obviously are ones that we're holding these in the interest of investment. We're holding these for the purposes of hopefully they will be worth more in the future than what we paid for them today or yesterday or whenever it was. So these are going to be long-term. Typically, we're going to hold on to these for 5 years or more, right? So let's just say these are long-term investments or equity investments, and we can see that these are $50,000 as well. This gives us a total of long-term assets of $920,000. And we're just simply going to add these two together. We're going to add our current, we're going to add our long-term, and that's going to give us total assets of $1,570,000. Okay? So now we know this is our A, right? A, assets equals $1,570,000. So what does that tell us? Well, that tells us that our L plus our E, our liabilities plus our equity, must also equal $1,570,000. So when we go through, when we do here in just a second, when we go through and we do our liabilities, when we do our equity, we'll see hopefully that they add up to that. So let's erase that for the moment, and we're going to erase all of the asset stuff that we just did, and that's okay. I'm working in my office, so I've got a somewhat smaller whiteboard than what we would typically have in a classroom. But now we're going to start on liabilities. What are liabilities? Remember, liabilities are simply the claims on resources that others have, right? So creditors, vendors, things like that. These are people that have claims to our resources or our assets, right? So we are liable for these. I always think I'm liable to pay that money at some point in the future. If I have bought something on account, if I bought 5,000 pencils on account, I am liable to pay the cash value of that in the future. So again, we're going to start with these in the order that you would likely pay them is typically how we look at these liabilities. So here we see we've got accounts payable. So accounts payable, we will usually shorten that down to AP, okay, is what we'll call that in this class. We see it's $170,000. Well, what does that mean? Well, we have bought $170,000 worth of assets probably on account, meaning we didn't ever give them cash yet, but now we've created this accounts payable account. We've created it to remind ourselves, hey, at some point in the future, probably within the next year or so, if it's an accounts payable, really, it's probably in the next 30 or 60 days. But let's just think of it in terms of year. Probably in the next year, we're going to have to actually pay cash for this, right? This is going to be a cash outflow to us at some point in the future, pretty soon. So that's accounts payable. Next one we've got is salaries payable. Kind of the same concept, right? These are salaries that we owe to our employees that they've earned that we've not yet paid them. We can see that one is $40,000. Next one, we've got interest payable. So again, this is we've borrowed money from a bank, we've signed a note, something to that effect, and we now have to pay interest every year. But let's say every quarter we calculate that interest and we add it here and we say, oh, okay, well, we've had that loan for 5 months out of the year. Here's 5 months worth of interest that we haven't paid yet, but we're gonna pay, okay? So that's gonna be $10,000. And then we've got current portions of long-term debt. Remember in your slide, I told you guys to be cautious with these, right? That there are current portions of long-term debt. So current LTD, so that's going to be current portion of the long-term debt is $20,000. And these are all of our current liabilities. These are liabilities that we expect to repay in full within the next year. So we've got current liabilities right here. And that's going to equal 210, 220, 200, and, 210, 220, $240,000. This is why you should always use a calculator, not just your brain. Okay, so remember, these are just current liabilities. Now we got to look at our long-term liabilities. We've only got two. We've got notes payable. So think of these these are just like a loan from the bank, right? So you've taken a loan out from the bank. A note is very formal, though. You've signed some kind of covenant. You've made a promise to pay this money back in a certain way at a certain percentage rate, right? So notes payable is going to be $180,000. And then it looks like we've issued some long-term debt through bonds. So we have basically borrowed a bunch of money from a bunch of different people in the form of bonds and have promised to pay them back $500,000. Okay. Now we see we've got our total long-term liabilities of $680,000 right here. And then we're going to add our current and our long-term together, and that's going to give us $920,000 in total liabilities. So let's just say liabilities equals $920,000. So we know we're still $650,000 short of making our fundamental accounting equation balanced. How are we going to fix that? Well, with the last portion of our fundamental accounting equation, that E, right? The equity portion of our fundamental accounting equation. So let's go ahead and work through the equity portion of that. And we see we've got common stock. What is common stock? Well, it is percentage shares of our company that we have sold to third parties. So this is what you would see like if you're buying stock on Robinhood or if you're buying stock on the stock market, if you go through a broker, this is what you're doing. You're buying shares of ownership, percentages of ownership in a company. And that's what we've done here. We have sold some of that in the value of $400,000. And we've also got retained earnings. Retained earnings is one that I find that sometimes students get somewhat confused about. And really, there's not really a reason to. What is retained earnings? Well, it's in the name, right? It's earnings, money, that you've retained over a course of time. Okay? So any portion of your net income that you didn't pay out to shareholders is your retained earnings. They are earnings that you've retained, that you have kept to yourself. You are able to reinvest those back into your company, right? Anyways, we have retained earnings of $250,000. $650,000. If we add those together, we see we've got $650,000. That is our total stockholders' equity number. So now let's look at this objectively. Okay, we've got assets that we know equal $1,570,000. Okay, we've got liabilities that equal $920,000. We have equity that equals $650,000. These two together, the L plus E portion of our fundamental accounting equation, equal $1,570,000. Would you be okay? Would you agree that this number equals this number? If so, then we know that A equals L plus E, and we are happy, and our balance sheet appears to be correct. So, any questions about that, feel free to contact me. You can email me. You can set up an appointment through my You Can Book Me page. Whatever it is you feel like you need to do, I'm happy to walk through this again with you, walk through another example with you, take a little more time to explain things in a little greater detail for you if that is what you need. So, thank you for paying attention. Appreciate it.